Right, everyone. So we're here today here to discuss how to select a specific fund. So I think first of all, you just need to understand that your portfolio as a whole needs a sort of diversification. If you don't understand why, just type in diversification in my blog, and then you can read why is diversification important. It's something that a lot of people have heard of, but do not fully understand. So just go there first. And secondly, I'm giving you an example that's the All Weather Portfolio from Listen Money Matters website, but basically was created by Ray Dalio, one of the most successful investors of all time. So it's just an example of how you can diversify. So, for instance, stocks 30% of your portfolio would go to domestic ones, and then for 55% in bonds, and then the rest in real assets, commodities, and gold. And it's more or less what I've sort of done with my portfolio, but not quite. So first of all, I think the first thing that I would do is just to look at the 5-year um, compound annualized rate of a fund. So, for instance, this is an index fund, Fidelity Index UK with the JBP income. So you can see that over the last 5 years, annualized would come return about 6%, which is a little bit over its category. So it's a good fund for that category. And then the second thing I will look at is the ongoing charge. So 0.06%. So it's very, very low charge because this is an index fund. So therefore very, very good. So that is one of the funds that I would have in my portfolio because I would want domestic stock, and that is something. And then the second one that I've got is the Fidelity Index, but for the US market, so S&P 500. But that's on JBP income because I figured that the pound is quite devalued right now due to Brexit, so therefore it's something that I want to hold in pounds rather than in dollars, which is very overvalued. And then you can see the latest performance quite well. But then what you need to judge it for is 5 years annualized, which is 15.6%. That is a massive performance. Basically, all that means is that if you left your money there without touching it, you would double the money in 7 years, which is great. Um, the charges you can see as is an index fund is very, very low ongoing charges, but they also have a transaction cost. So whenever you buy, you pay 0.01%. And these are the things that you don't really realize how they eat your principal. But if you go into my fees calculator spreadsheet, you are able to just type it, your initial capital. Let's say if you have £10,000, it's going to fill up for you. So for instance, if you have Fidelity total fee versus using robot apps, you can see that at the final difference of after year 30 is £700. But year 10 would be about £70 just on that amount of just for having a different fee, because the apps would charge a little bit more. If we move to gold and resources, so the commodities part, so you can see quite a shocking performance, but it usually performs when the market is very cautious. So in 2016, the market was very cautious, so it performed 91% up. In 2019, it was also a little bit cautious, so 31% up, but the rest of the year is double-digit decline. But if you compare the performance of the last 5 years, it's quite good to see. Is 9%, 9.5%, which is quite considerable. If it's better than the UK index fund, but worse than the US one so far. But then you can see that the charges are much higher. Why? Because it's much harder to actually hold the gold contracts, and that is not an index fund. That is just a fund by one of the providers. So they always charge you a little bit more because there are investing professionals behind that fund. And then my last one is the Vanguard emerging market. So you can see, for instance, performance last 5 years 7%, but then the charge will be a little bit higher to 0.24 because it's an emerging. So that's all for now. Thanks very much.